The stock market should have already collapsed. Every major signal is flashing warning signs. Consumers are buried in debt, the economy is clearly weakening, yet somehow the market keeps climbing. And I'm going to break down exactly why that is. Because once you understand the hidden forces holding this market up, you'll understand why the crash hasn't happened yet, and why the delay is actually the most dangerous part. I've worked across fintech and banking for decades, and despite having a finance degree and an MBA, I used to look at the headlines, recession warnings, runaway inflation, and wonder how the market kept drifting upward. Then I found something most people never bring up. Markets don't crash simply because things look bad. They crash when the invisible support beams finally snap. And once you see those forces clearly, everything happening right now starts to make sense. So let's break it down. The main indicators are all pointing toward a market correction. If you look at them in isolation, the stock market should have fallen already. So the question becomes, are the indicators wrong, or is the market itself out of touch? Take Warren Buffett. He's sitting on piles of cash right now because one of his preferred valuation metrics, one that most people ignore, is signaling extreme danger. He compares the total market cap of all public U.S. companies to the U.S. GDP. Currently, the combined market value is around $66 trillion. U.S. GDP is roughly $30 trillion. Divide those two, and you get 220%. Here's the terrifying part. Anything above 100% is considered overvalued. For context, right before the dot-com bubble burst in 1999, the ratio was 115%. Not 200, not 150, only 115%. And the market still crashed by more than 60%. That alone would make you assume a crash is overdue. But here's what nobody is discussing. Do P/E ratios even matter anymore? Based on market behavior, apparently not. And it's not just that valuations are high. There's a deeper problem that's even more concerning. Historically, S&P 500 companies trade at PEs around 15 to 16. Today, we're sitting around 25 to 28. That's elevated, but that's not the main issue. The real danger lies in the companies driving the index higher. And this is where things get uncomfortable. NVIDIA's P/E is hovering near 53 to 55. A normal mega-cap company typically sits in the 20 to 25 range. Tech firms usually run slightly above average, but not double or triple. Amazon's PE is 35 to 37. Microsoft's is 35 to 40. And the most shocking, Tesla sits at a PE of around 286. This means investors are paying dozens of dollars for every single dollar of earnings. Would you spend $50 for a $1 candy bar? Sounds irrational, yet people keep buying these stocks. And something else should concern you. Before the dot-com crash, S&P 500 P/Es were around 29 to 32, nearly identical to today. All these metrics suggest the market is overdue for a major correction. Yet nothing's happened. Next, the hidden forces holding the market up. Despite inflation, rising household debt, weakening job data, layoffs, slowing corporate earnings, inflated PEs, and one of the most overvalued markets in history, we still haven't seen a collapse. Why? Because two powerful forces are artificially keeping the market afloat. Force number one, ongoing demand stimulation, done quietly. Officially, government stimulus is long gone. But if you look closer, the government is still injecting money into the economy in ways most people never notice. Expanded credit pathways, higher government spending, business-friendly tax structures, what many call corporate welfare. It's stimulus in disguise. Let's look at spending. The government collects roughly $5 trillion in taxes each year, but spends close to $7 trillion. That extra $2 trillion flows into companies, contractors, employees, and then into consumer spending, boosting corporate profits. That spending spree props up the economy, whether people realize it or not. But here's the problem. The U.S. now carries $38 trillion in national debt, with over $1 trillion a year in interest payments alone. How long can this level of spending continue before something gives? Probably not long. And surprisingly, this isn't even the biggest force at work. Force number two, dollar devaluation, and inflation. If you've been following economic policy, you know the current administration wants a weaker dollar to make U.S. exports more competitive. That part is public. But there are deeper factors reducing demand for the dollar internationally. First, several nations, especially BRICS countries led by China, are moving towards settling global trade in currencies other than the U.S. dollar, and it's accelerating. That reduces worldwide dollar demand. Second, U.S. Treasuries are no longer viewed as the automatic safe haven they once were. That also reduces demand for dollars. When demand for the dollar drops, its value drops. Combine this with the government's desire for cheaper exports, and downward pressure on the dollar compounds. And it gets worse. Inflation remains stubborn. A weakening dollar accelerates it. When the government keeps saturating the system with new dollars, inflation and devaluation feed on each other. More dollars chasing the same goods means higher prices. And when the supply of anything increases, its value typically falls. That's exactly what's happening to the dollar. So your dollars are quietly losing purchasing power, even if your bank balance hasn't changed. But here's the real question. How does this keep the stock market inflated? Simple. Heavy government spending keeps consumer spending alive and fuels inflation. The dollar keeps losing value. The outcome? Companies raise prices. When prices go up, revenues go up. Not because businesses are more productive, but because your dollar buys less. That's why corporations still report record earnings even when demand weakens. It's inflation masquerading as growth. And Wall Street understands this. Higher reported earnings mean higher valuations, even if those earnings are artificially inflated by rising prices. And here's what almost never gets mentioned. Borrowing to buy assets becomes incredibly profitable in an inflationary environment. Your debt becomes cheaper because you repay it with weaker dollars. Your assets rise in value because replacement costs rise too. Inflation rewards people who buy assets using borrowed money. And institutional investors, hedge funds, large firms, are exploiting this right now, borrowing massive amounts to buy stocks. If inflation stays high, they win big. These forces work together to support the market and keep large investors fully invested, which leads to the inconvenient truth. The top 10% owns nearly 90% of the stock market. So as inflation and dollar devaluation build, the wealthy get wealthier, while the remaining 90% watch their cost of living explode and their purchasing power collapse. But here's what almost no one is considering. These supportive forces are temporary. They delay the crash. They don't prevent it. Third, why the crash is taking so long to show up. Let's answer the biggest question. If everything looks bad, why hasn't the crash hit yet? Because most people misunderstand how markets truly collapse. Crashes aren't triggered simply by bad conditions. They're triggered when confidence breaks. Think of confidence like an overloaded bridge. A few cracks won't take it down, but the moment the final bolt snaps, the whole structure collapses instantly. Right now, confidence is held together by three weakening threads. Thread 1. Consumers are still spending money they don't have. The U.S. economy is driven by consumers, making up about 70% of GDP. Yet personal savings are near record lows, and credit card balances have hit all-time highs. People are spending borrowed money, and that can't last. When consumers finally pull back, corporate earnings drop, and the market follows. Thread 2. The labor market looks strong, but isn't. The no hire, no fire trend that defined the last few years is fading. Hiring has slowed sharply. Layoffs are increasing. The labor market is not healthy, it's lagging. And historically, lagging labor markets appear right before major economic downturns. Fewer employed people means less spending. Less spending means weaker earnings. Thread 3. Rate cuts won't save us this time. In past cycles, lowering interest rates revived the economy. But today we're dealing with massive debt levels, high living costs, and squeezed consumers. Cheaper rates won't magically fix these structural issues. And this brings us to the final and most important factor: the cycle of false confidence that always happens right before a crash. What happens right before every major crash, and why it's happening again? Crashes follow a predictable sequence, and all three stages are already underway. Phase 1. Markets stay irrationally high for far longer than people expect.
We're living through this right now. Investors are annoyed that the market feels disconnected from reality, but this is exactly what happens before every major downturn. Phase 2. Investors get desensitized to bad news. It's called crash fatigue. Headline after headline hits: inflation, layoffs, profit warnings, and eventually people stop reacting. That's classic pre-crash psychology. Bad news stops causing movement right before the moment it matters most. Phase 3. A confidence-breaking event triggers the collapse. It doesn't have to be dramatic. A single bankruptcy, a credit shock, a major company missing earnings.
One event sparks a chain reaction. Confidence collapses, selling accelerates, and the crash everyone expected months ago finally unfolds. And confidence is already cracking. The University of Michigan Consumer Sentiment Preliminary Index for November came in at 50.3, near historic lows and below expectations. The reason crashes feel sudden is because people confuse delay with safety. But delay doesn't mean protection. It makes the eventual impact worse. The longer the collapse is postponed, the faster and more violently it happens when it arrives. And here's the truth they don't want you to realize. The market hasn't crashed yet, not because the economy is strong, but because temporary forces are holding it together. When those forces weaken, and they will, the market won't gently drift downward. It will snap back to reality. The crash isn't canceled, it's cued. And the longer it takes, the bigger it becomes. This isn't about fear-mongering. It's about recognizing the cycle so you can protect your finances, stay logical, and make better decisions while others panic. If this breakdown helped you cut through the noise, make sure to like and subscribe. We post clear, practical, no BS content every week to help you build and protect your wealth.